Welcome to eXp Invest. I am Kavita and I bring to you stock market related content. I post stock market updates and daily market outlook on my free stock market Telegram channel. Here on YouTube, I post the weekly wrap up. In this market outlook series, we will discuss the entire week's activities and ponder upon what might be coming next. If you're interested in stock specific analysis, do check out my Let's Get Technical series after this video. Now let's start with a view of the Nifty's charts. This is a 3-minute chart of Nifty showing the entire week's price movement. Every time RSI came to the level of 30, a small RSI positive divergence indicated a subsequent rally in the index. But every time that positive divergence indicated a rally, the rally kept getting weaker and weaker. In the second rally, RSI clearly failed to move above the level of 60, which is the RSI resistance level in a bearish market. Today again, RSI has shown RSI positive divergence, and after a sharp decline, it wouldn't be surprising if some bounce back in the short term came about. However, the resistance for this would be this 200-day moving average at the level of 17,968. Now let's move on to the 15 minutes chart of Nifty, where we are covering a little over 3 weeks of price action. On the 16th of December, this RSI on the 15-minute chart reached the level of 30 and breached it. This was an indication that price weakness is going to continue. In the last market outlook series, we identified the support level of 18,200 and 17,800. As you can see, this week the 18,200 level has already been breached and 17,800 level has also already been reached. Currently, despite of the sharp decline in prices, we can see that RSI has reached the level of 30 and is maintaining itself above the level 30. So clearly the price is below its previous low, but RSI is above its previous low. This is giving us a positive divergence on the index in 15-minute chart. In our last weekly market outlook, we mentioned that RSI on 15-minute chart of Nifty had touched the level of 30 and was expected to rally. But it did not rally. Instead, it created a pattern which was a bearish continuation pattern. Let's take a look at it. There is a broadening triangle, which is a bearish continuation pattern formed on the chart of Nifty this week. This 15-minute chart is showing a coil-like pattern where every time the high created by the index was higher and the low created was lower. This broadening triangle has given way to another 400 points of decline on Nifty, therefore completing the pattern. A lot of us might know that broadening triangles give a target of the same length of correction which preceded before it started forming, and in this case that level of correction has already been completed. Now let's move a time frame higher to the 75 minutes chart and see what's going on. On this chart we can see that the support trend line has been breached, but we are on the 75 minutes chart to look for the next probable level of support if the level of 17,800 gets breached. Below this level we can see there is the first support coming in at the level of 17,400 because there was a previous high over here and few gaps and a lot of activity around this level. So we can hold this out as a near-term support. But if this level gets breached, then major support will come in from this level of 16,800 where there is an open gap yet to be filled. That being said, if the level of 16,800 is breached, then things will become worrisome because below this level there are a series of gaps which we experienced after the low of June in 2022, which led to the fantastic rally witnessed all the way until the beginning of December. Now, if the level of 16,800 is also breached, then there is no stopping Nifty from going as low as the level of 15,900. Do you know the best strategy for a market condition where lower and lower support levels start staring us in the face? It is to stay true to your market strategy. Follow your stop losses and maintain your discipline. Do not get swayed by greed and fear. The fear of booking losses and the greed of expecting unrationally that the prices will reverse and go back to your entry level. Make sure you're keeping your losses small. The market calls for an attitude of capital preservation and not chasing profits. Now let's take a look at the relative sectoral performance of the week. This chart shows the performance of all the sectors since the start of this week, and clearly last week's losers are this week's winner. Some of those names are Nifty Healthcare and CNX Pharma, which have closed in the range of 2 to 3% positive. But last week's winners are also this week's losers, as we can see with PSU Bank, which closed a steep 10% lower, along with every other sector closing between the range of 2 to 10% lower this week. Now let's take a look at some of the sectoral charts which have some interesting observations for us to discuss. As the markets are becoming quite bearish, I want to discuss the FMCG sector because a lot of people have this notion that in bearish markets, the FMCG stocks are the best to play with. On this daily chart of the FMCG sector, I can see to start with there is a double negative divergence, which is not good news. In addition, the last part of the rally, which started since the second week of July, is a typical extended rally because firstly it started, it happened against a negative divergence. This basically indicates that the momentum of the FMCG index was not very good relative to its own stock price action, or rather its own index price action which was witnessed earlier. Now let's move on to the 15-minute chart of Nifty, where I have drawn a trend line to join all the lows of the extended part of the rally seen in the last leg of the FMCG sector. Here we can see that the price has already reached the level of support. There is a small positive divergence which has been formed on the last trading day of the index, but avoid making any new positions because despite of the small positive divergence, if there is any upside, I don't expect it to be more than 3 to 4%. So avoid making new positions, and if you have existing positions in the FMCG sector, depending on the stock and its specific outlook, try to wind up your positions. Talking of support, if this support trend line is breached in the coming week, then there is a support available 6% lower, which seems very probable for the index, but if things go worse, it can also fall as much as 12%, and a 12% decline in the index would easily convert to more than 25% decline in the stocks, again depending on specific stock analysis. Now on this daily chart of the infra index, the tendency of the index to plateau for a while near the top level and then absolutely plummet nearly 20 to 40% is becoming very, very evident. Let's zoom in to the most recent price action, and on this 15-minute chart we can see that the support trend line has already been breached on the index, a massive negative divergence on the chart. So this sector is best avoided for the foreseeable future. Switching to the 75 minutes chart and taking a look at the most recent plateauing behavior, we also see there was a fake breakout which has obviously not been sustained. The same RSI negative divergence was also visible on the 75-minute chart. So considering that the stock, as we said, has a tendency to plateau and plummet, we can expect the index infra to fall at least a 15% from this level if the whole market continues to remain as negative as it is right now. But it can also go 27% lower, and 20% decline in the index itself compounds many more times in stock specific analysis. Moving on to the last sectoral index chart, this is the daily chart of the media sector, which is showing signs of positivity on the RSI. We can see the RSI is in the lower segment of the positive range in which it has been oscillating since the 30th of April 2020. Now let's analyze the upward trending channel and see the behavior of the stock on intraday time frames. On the 75-minute chart, we can see that every time the index has touched this particular support trend line, it is given a very handsome return of nearly 25 to 30%, which is great. Now let's move a time frame lower to see what kind of behavior has the index shown every time it has touch the support trend line. This is the 15-minute chart, and we are looking at the first instance when the media index touched the support trend line. We can see there was a positive divergence on the chart. Moving forward, on the second instance, which happened approximately in the middle of April 21, we see again there was a positive divergence, and then the index rallied massively. The third instance, when the index again touched the support trend line, also a positive divergence between price and RSI was noted, followed by a subsequent rally. Now again the price of the index has touched the support trend line, and there is a small positive divergence. Now I would say the positive divergence is not completely developed, but there is a possibility of rally in the media index currently. I believe that with some strict controls, the media sector can give some sweet momentum trading opportunities in the next 2 months. This sector can be added to the list along with the pharma sector, which we identified in the last market outlook video as a potential trading opportunity for the next few weeks and months. Just knowing about the broad market and sector analysis is not enough. To be successful in momentum trading, you need to know the stock name, the entry level, the stop loss, and target price. Through eXp Invest, I share stock ideas with my members in a subscription model. There are monthly and annual models for you to select from. Visit my website for more information about the subscription plans, and if you want to buy individual stock ideas, you can do that through my free Telegram channel, which is linked in the description box below. So this was all for the Market Outlook series this week. I will see you again next week. Don't forget to leave a like and a comment below. Thank you.